All right, so by now you should know that there are so many different strategies out there in which you can trade. When it comes to scalping the futures, I like to use a higher base chart and move down to a lower base chart. And, I'm looking for multiple means of confluence, as you should as well as a trader if you want to have the trade more so move in your direction, especially looking for high probability zones. Now, what is a high probability zone for me? It may be different from one person to the next person or trader, but one of the key components, which I'm going to talk about in this video and share with you and show you on the charts, is what is classified as a unmitigated or a gap or even an imbalance resting back at a zone. It could be a supply zone or a demand zone. So you want to really focus on to make sure if you're taking or looking for high probability setups, are you taking trades or are you waiting for the market to pull back to key areas where is an imbalance resting back at the zone? Okay. So for example, I'm just going to show you here. We'll take a look at like the ES, and some of you may trade the micro E-minis. This is the E-mini ES S&P 500 futures. And there's a difference in between what is classified as a no gap or gap zone versus an unmitigated versus a mitigated zone. Okay. Let me explain that right quick. A mitigated zone is one where there is no gap left back at the zone. An unmitigated zone, of course, you should know that where there is an imbalance or a gap resting back at the zone. Okay, so the same thing. If you hear me say gap or unmitigated or not gapped or mitigated zone, they're all the same. Okay. By now you should hopefully know that. If you are a beginner and it's your first time understanding and researching information about imbalances, or when you hear the term gap or unmitigated, just know what I'm saying when I talk about it in the videos here on my channel. Again, gap at the zone means that there is an imbalance resting at the zone. There's a small gap resting back at the zone. So that's what we're looking for. We're looking for areas where the market, say if it's an example of a demand, where the market had aggressive push or buying to the upside and it left a gap there. Okay. The way I like to think about it is that there is an imbalance, which means there's potential of orders resting on the table that need to get filled, okay? And in reverse of if it's at a supply area, okay? So I'm going to show you a couple areas on the charts and identify the actual gap so that you understand. Again, you could call it a scalping secret or a trade secret, but not many people go off of this style of trading. You may see some people doing it online or different videos, whatever the case is, and they may trade or have a different strategy in how they trade surrounding gaps at a zone. And some people will trade, mark off zones, whether it's a high probability or low probability, no gap, high probability, gap. They would trade all of it, okay? I personally preferably only like to trade the high probability parts where there's a gap at the zone, okay? When I'm talking about the strategy and how I trade. So if I'm looking here at the ES, and one thing you want to make sure always is to understand structure is the most important part outside. And honestly, you should be learning that from day one. When you start researching the markets and kind of figuring out which markets you want to trade, whether it's the indices or commodities, currencies, whatever it is, you got to understand market structure and being able to identify breaks of structure if we're moving to the upside, making higher highs and higher lows, and then knowing when the market is reversing. That is a critical part to trading. As you can see here, the market had been, this is going from September, going into October, making higher highs and higher lows, breaking structure to the upside. So if I was to identify key areas where there's high probability, say for example, demand at off of this breaking structure to the upside, well, it would be, I'm gonna blow this up for you right quick. It would be from this area right here, okay? You see where the market made this high at, made this low at, and then broke this area structure above here. All right, we broke structure. Aggressive buying. There is a gap. This bullish candle that broke above this last down bearish candle on this swing pullback right here, on the pullback right here that broke higher. The top end of that wick right there, of that bearish candle right there, the next candle that broke above it, broke above that bearish candle, meaning body of the candle plus the wick, there is a gap there. The gap is from the top end of that wick, okay, to the next candle that breaks above. Okay, so we got the break and close of the candle here. The next one that closes above. We're measuring that way from the top end of the bearish wick or bearish candle, okay, to the bottom end of this, basically this third candle that breaks above and closes. So there's a small gap right there. All right, you see it? So again, what we would be looking for is for the market to come back to this area, fill this gap in, and then move down to our lower base chart to look for some means of rejection. That's all in part of the scalping strategy and how I trade using multi-chart confluence. Okay, again, so there's a gap right here in this area. So if I was to mark that off with like a rectangle box, we can kind of shade it in. There it is, small gap in between that area right there. Then the market moves higher, pulls back. We get a break of structure above. Let me move this down some so we can see. Okay, but on the pullback right here, what you can see is that, yes, the market pulled back, but then we have structure breaks to the upside, or it makes highs, higher lows, and it breaks higher right here. There's a gap right here. Okay, there's a small, actually, let me see. Yeah, there's a small gap. That's why I had this box drawn off right here. So the gap would be, again, let me show you. Arrow line, top end of the bearish candle to include the wick, and let's move this box out the way. Okay, and then arrow to the the candle that closed above it, and then the next candle. So it'll be this candle right here. Okay, or really this candle right here, because we got one second candle closed above it, and then this bearish candle, which at the time is probably was moving back and forth, bullish and bearish. But as you can see, it swung back this much right here. Okay, so it would be from right here until this next candle that formed, which came a little lower. So then we move this down a little bit lower. So there's still a small area or gap in between this area here. So when the market broke above here and broke structure to the upside on this little bullish run to the upside, it pulled back, it filled in that gap right there back to the demand zone and took off to the upside and broke structure again back to the upside. The gaps or unmitigated zones are a central part to the means of how I actually trade supply and demand. Okay, it's critical, especially when I'm scalping the Nasdaq 100 or the E-mini S&P 500 or even the YM, the Dow. It doesn't matter. I've got to see a gap back at the zone. I need to see that imbalance resting there. Okay, all right. So here's another area right here. I'll show it to you. Okay, the market was breaking structure to the upside, and then we get a bearish run to the downside. Then it turns back around and starts to break structure back up, taking out these highs right here, leaving behind this area of demand right here. So again, there is a gap. I'll mark it this way. Top end of that bearish candle right here, when the market pushed up, pull back. This bearish candle right here to the gap is this much right here. Okay, so from that candle, so we have the break above that candle, that bearish candle right there, candle, and then the next candle, and then we get a pullback right here. So there's a small little gap right here. So when the market finally comes back, the demand zone is going to be right here. We'll draw it off. And as you can see, it fills the gap right there, taps the zone, and eventually pushes to the upside. So we're looking again for high probability setups where there is a gap resting back at the zone. All right, so here we're looking at the Nasdaq. I just want to show you, the difference of when there is no gap at the zone. Okay, so for example, so if we're in, bullish, well, this was bearish to the downside, and then we started, bullish back to the upside here, and we started breaking structure to the upside. As you can see, we pushed lower, making these lower lows and lower highs. Then we broke structure to the upside, taking out these highs right here, and then moved higher, pull back, broke structure, pull back, broke structure. So what I'm trying to say is here, if you pay attention, like right here, for example, let's see, there's actually a gap right here, but on this area right here, where the market pushed up, let's say like right here, came back and then broke structure above this area here. All right, so if we see that right there, pay attention to this area back at this demand zone. All right, this is what I like to classify as a minor or a high probability, excuse me, take that back, a low probability zone. Okay, because there is no gap at the zone. Again, what are we looking for? The top end of the bearish candle, where there's the last bearish candle to the downside, even in a swing. Okay, because the market could have pushed up, pulled back, and then swung up and had a bearish candle. But anyways, let's move forward. Anyways, what I'm trying to say is that you notice the structural break to the upside right here. The top end of this bearish candle, You see with that candle, the bullish candle closed above it right there. And then the third candle, what did it do? Did it push up and close above? It actually came back, swung back, and filled the gap right here. So if there was a gap, say for example, where it started at the top end of this candle, the bearish candle, and then this candle here that broke above, okay, we're looking to see how that third candle closes. If it closes strong to the upside, then there's going to be a gap below. But this candle here pushed up a little bit and then swung back, filling in any kind of imbalance, resting back at that top end of that bearish candle. So this makes this area here low probability, okay? That third candle wicked the top end of that bearish candle there. So this is a low probability area of demand. Now, will the market sometimes reject those areas still? Yes, it will. I mean, you can see what happened here. It pushed up, came back to that area, and still rejected off that area there. Okay, so, you know, sometimes it will, but you got to, I take trades based on what's high probability, okay, or the highest probability. Not all the times that this is going to work out. I mean, if you do back testing yourself, you'll see that lower probability setups will, or lower probability demand or supply zones or setups tend to not work as well as those that actually, where there is a gap resting back at the zone, that are higher probability. Here's an example of a low probability, mitigated, tapped, no gap supply zone. Market pushes lower, break a structure, okay? So we got to break below this area here, but take a look here, all right? When the market actually broke structure to the downside, okay, before it did so, here's the last, we're doing things in reverse of now, okay? So we're talking about when we're looking at a demand area, the last bearish candle in a swing, okay? The top end of it, and then, you know, the candle that closed above, and the third candle that closed above that to see how much of a gap is going to be left. In this case here, we're looking at the last bullish candle to the upside. So push up, broke back, last bullish candle to the upside, okay? And then the candle that closed below it, this bearish candle right here. So the gap would actually start right here, okay? And then the candle that closed below, normally there's going to be a bearish candle that will close strong to the downside and will probably leave it like this much gap. In this case here, we don't have that because this candle closed below the last bullish candle to the upside. This candle here eventually closed, but before it actually went up and wick the top end, or excuse me, the bottom end of that bullish candle, the wick of that bullish candle, closing in the gap there. So it makes it a low probability zone, okay? Can it still reject? Yes, it can still reject that area as it did, came back to it, rejected it some before pushing higher, as you see that. So just be careful when you come to trading unmitigated versus mitigated zones. I tend to look for more ones that are of higher probability where there's an imbalance resting at the zone. I like to think of that in terms, again, as there's still orders resting on the table. The market quickly pushed away from a zone, and then it came back to the unmitigated zone, okay? All right? Meaning if it was, say, for example, let's say this right here was, you know, broke structure to the upside here, came back. Look at this aggressive buying right here. Top end of the bearish candle here, broke above, third candle. There's a gap resting right here. Where's the gap at? Say, for example, top end of the bearish candle of the wick, third candle, bottom of the third candle, right there. It never came back and filled that gap in. So if it comes back there, to me, that's an unmitigated zone with a gap at. There's a high probability chance that the market will react here, you know, and probably push up. We don't know how much, of course, but you also got to pay attention to price action, okay? I'm just giving you an example, you know, of what, again, what a mitigated versus unmitigated zone looks like. We're talking about zones where there's a gap versus ones where there are no gaps. That is all part of the scalping strategy and how I actually trade. It is one of the key components in the strategy that I talk about here on the channel when I'm marking up zones, okay? Spend some time watching the video, especially if you're a beginner trader out there and your first time actually viewing the channel for today. I got tons and loads of great, valuable videos packed with valuable content surrounding the strategy. I go in great depths and detail about the strategy and how I trade it as well. But for all those that may be interested in getting more insight, more information, wanting to get the bigger, I guess a more bigger scale how I go about taking trade setups, my mindset, the thought process, where I break trades down. You might want to become an elite member, because people are always asking me how can they join the elite membership program. It's only $6, $6.99, so $7 as a whole. Okay, and that's monthly. You can subscribe to it by simply going down to the latter part of the video. Down in the description part, you'll see a link right below the Discord link. It says become an elite member. If you click on that, 2 tiers will pop up. The second tier is the one you want to click on and join for $6.99. You get the trade breakdowns, and there are tons of them on there covering trade setups that I posted over our Discord community. And then I go back and I do private videos to for the elite members. Okay, so that because you guys are supporting my efforts as a content creator, so I'm giving something back as a means of a perk or reward through the YouTube tier program. So you also get the video playlist, so you don't have to sit there and watch over 800 some videos. I go into detail. I've hand selected videos that kind of summarize, okay, in a sense, video by video, hand selected videos off the channel, ones that are critical, ones that cover the most valuable information surrounding the strategy and how I trade, okay? But again, I mean, you can sit there and watch tons and tons and tons and tons of videos here and take notes. Nothing wrong with that. But I try to circumvent the system in a sense by providing the video playlist, the trade breakdowns, again, which go in deep detail about trade setups. I also talk about stop losses, where to place them, profit target areas, and things of that nature as well. Plus, the biggest one of the perks that you get also is the video that I covering market structure. All right, market structure 101 video. Okay, for those that are struggling trying to understand that, I go into detail about that and break things down because people are visual, so they we thrive off of seeing. Lots of people are visual, I should say that. Thrive off of seeing actual examples and visual representation of things put before us, okay? And then we take that and we go back and practice. So again, if you're interested in becoming an elite member, the link is down in the description portion of the video. So just click on that, and again, you choose a second tier. Outside of that, if you are a first-time viewer, please take the time to go ahead and click on that subscribe button now. Join the team. Come over and join us on the Discord as well. But join the channel by clicking on the sub button. Make sure to turn your post notifications on so you don't miss any of the uploads. And last but not least, if this helped answer your question in reference to, gaps versus ungaps, mitigated versus unmitigated, imbalances versus zones that don't have an imbalance resting at, leave a comment down below in the comment section and let me know and say, hey, thank you, Mike. This has cleared up and helped me understand when it comes to talking about, gaps and unmitigated zones versus ones that aren't. Okay, so I try to break it down. All they are is those little gaps in between. The market is racing, moving away from a supply zone that is created or a demand zone that is created, and we're looking for that gap back at the zone. That's going to help target those high probability setups. Okay, that's all I have for you guys today. I appreciate you tuning in. I'll see everyone in the next one. Take care.